LinkedIn is on. And I'm waiting for last but not least, YouTube. Okay, yeah, YouTube is on. All right, my name is Darren Joseph from HPJ.tax, the team that seeks to demystify the sometimes confusing world of cross-border taxation. And today we have the honor and the privilege of having a conversation with Roger. Roger, can you please introduce yourself?
Hey, Darren, how are you? And hello, everyone. My name is Roger Chi. I'm the CEO of the Singapore office for 1291 Group. We are based in Zurich with 13 offices around the world. Zurich, Geneva, Liechtenstein, London, Panama, Bogota, Sao Paulo, Mexico City, Dubai, Hong Kong, and most importantly, here in Singapore.
Wow, okay. And the fact that you remembered all of those, that's that is pretty impressive.
There we
So
go.
the basic question, what exactly is a PPLI?
Sure. So before I begin, I'll just tell you a bit about 1291 and sort of what we
Oh,
do,
sure.
right? And then
Please
we can
do.
then
Yeah.
jump into PPLI and specifically how
Yeah.
that may be able to help some of your clients.
Sure.
So people always ask me 1291, what do the numbers mean? It's the
Hmm.
founding year of Switzerland. So
Hmm.
that's your Jeopardy fact for the day. As I mentioned, based in Zurich. And what we do is we work with high net worth families globally in building what I like to call asset holding structures. And what does
Hmm.
that actually mean in plain English? So historically, if you're a wealthy family, you held all your assets in a BVI, a Cayman company, a Singapore company, or a trust, and then you sort of conveniently forgot about them. But obviously, with FACTA, with CRS, with CFC rules, with the Pandora Papers, the Paradise Papers, and the OECD cracking on these traditional offshore structures, these traditional structures just don't work anymore. However, high net worth families still want privacy. They still want asset protection. They still want legal tax optimization, with the keyword there being legal. They want to do some next generation estate planning. And maybe even wanted some liquidity or like a cash component. And that's sort of where we come in. So we build these structures for high net worth families. And what we see now is that for high net worth families globally, is that high net worth families globally are global families, right? So you have families who maybe first generations in Europe or let's say in Asia. That's what we see. Second generation, maybe there's a kid in the U.S. I mean, there's a kid in Australia. There's a kid in the U.K. They may have assets globally. They may have bank accounts in Taiwan or Indonesia, and but also assets in Singapore and U.S. and UK. And how do you sort of make sense of all those different things, right? And that's sort of what we do. And for the global families, I think one of our favorite tools, we use all the different tools. We use trusts, we use offshore companies, we use foundations, we use even the fund structures, which are like the Singapore VCCs and the Cayman SBC structures. But our favorite structure for families with sort of a lot of cross-border issues is using something called private placement life insurance, or PPLI for short. And that's very simply a derivation of two words. The words private placement, because investments are private placement, and the words life insurance, because the underlying vehicle is a life insurance vehicle. And I think a lot of people sort of ask me, why life insurance? Why not a trust? Why not a foundation? Why not, one of these other structures? And the answer is that life insurance works in both common law countries, which are countries conquered by the UK, but also civil law countries. And if you look at the map, most countries in the world are actually civil law countries. So if I go to a tax authority, let's say in China or Indonesia or I don't know, Kazakhstan or some places in South America, and they say, hey, look, I have a trust, they sort of say, so what? What's a trust? We don't recognize a trust. We see right through that because it's not in our tax books, right? So, but whereas with life insurance, even the poorest African countries, we have life insurance rules. Right. So I know exactly the benefits I get. I know benefits I don't get, and I know what things I need to do to qualify for those benefits. So those rules of the road are very, very clearly stipulated. And that's why we like to use the life insurance vehicle. The other
Mm.
reason why we like to use life insurance is that life insurance tends to be very boring. We like things that are very boring, right?
Hmm.
I don't like exotic things. I don't like offshore companies, bad. I don't like trusts, bad, things for the rich, right? Life insurance is something that everybody has access to.
Hmm.
And it's very common to have life insurance. So we actually like the fact that life insurance, has these properties that which are sort of available for the common man, but also specifically, we can take these traits and these, characteristics for life insurance and sort of apply to high net worth families.
Hmm. Okay. So having said that, and thanks a lot for that pretty comprehensive overview. That kind of touches on a lot of points. So can you give some typical use cases as to where the PPLI solution works
Sure.
for a given
Yeah.
family?
Yeah, sure. So very basically, what you're doing is you're taking a series of assets. You're taking
Hmm.
your bank account. It could be shares of your operating company. It could be
Hmm.
some real estate you own. It could be shares of that hot startup you're investing in. It could even be exotic things like Bitcoin, or let's
Hmm.
say a private jet or a yacht. It can be some very exotic assets. And what I'm
Hmm.
doing essentially is I'm transferring it from Roger's name
Hmm.
to the name of life insurance. So now what
Hmm.
happens is the life insurance company is what they call the ultimate beneficial owner. They now
Hmm.
legally own those assets. What I get back in exchange is the life insurance policy.
Hmm.
Inside my policy are my assets. Ideally, you have an asset manager who's managing those assets on your behalf, so it's arm's
Hmm.
length. In some countries, it's required to be arm's length. In some countries, it's not required. But we always recommend that you do have a licensed manager who's managing the assets on your behalf.
Hmm.
And in essence, is that we've transferred those assets to the life insurance company. It's owned by the life insurance company, and all you own is a life insurance policy, right?
Hmm.
From a reporting standpoint, you're still CRS compliant, you're still FATCA
Hmm.
compliant, but what you report back now, instead of reporting back 5 different bank accounts in 5 different exotic jurisdictions or a BVI or these different things, what you're reporting now is one simple consolidated line, life insurance policy, cash surrender value, $50 million or $5 million or whatever the assets are worth, and that gets
Hmm.
reported back. So it's consolidated reporting. It simplifies everything for you, and it puts it into one simple structure. And now
Hmm.
what's unique about these life insurance structures is that, because we knew the rules about life insurance across different jurisdictions, we can
Hmm.
now make it compliant for many different jurisdictions.
Hmm.
And many of the rules for different jurisdictions are actually quite similar or almost the same.
Hmm.
So it can, some of these life insurance policies initially on the offset can already be compliant for over 100 countries, right?
Hmm.
And so sometimes, if there's more sort of complicated jurisdictions, let's say a US and UK, for example,
Hmm.
we can do these, we can make it more compliant by just tailoring it so that it's specifically tailored for those different jurisdictions. So, for
Hmm.
example, we have a lot of cases where I have a lot of cases where it's dual compliant, for example, or
Hmm.
compliant for 3 different countries. It can be compliant for the US, for the UK, for France, and for China. So
Hmm.
it can be compliant for all these different countries, depending on where your assets are, and more importantly, where the different beneficiaries are, or where the
Hmm.
different people of the family are, and that way we can make it compliant for all these different jurisdictions. And so no matter what, you can make it compliant for all these different things, right?
Understood, understood. So then I'm gonna ask the opposite question. What use case or what particular scenario or example would it be not appropriate for?
I think it's actually appropriate for a lot of different cases, to be honest with
Mm-hmm.
you. I actually think it's a very robust structure. You can use it instead of a trust or a offshore company, or you can use it in conjunction with an and
Mm-hmm.
structure with these different structures, right? So, for
Mm-hmm.
example, the most common structures we actually see is perhaps like if you have a trust, that's fine, it's
Mm-hmm.
fantastic, keep the trust. The trust
Mm-hmm.
is great for succession planning, but it may
Mm-hmm.
not have, let's say, some of the tax benefits you're looking for, right?
Mm-hmm.
Because of CFC rules, or if
Mm-hmm.
it may not have, some of the privacy or asset protection benefits. So you may want to layer these different structures with I guess, a trust holding a PPLI structure, and maybe even below that holding an offshore company, a Singapore company, for example, and then holding an operating asset.
Okay. One, I guess, conventional thinking, and you correct us if I'm wrong, is that it's a relatively expensive structure to set up and maintain. How would you respond to that? Is it?
Yeah, so I actually think there's a lot of misperceptions in the market.
Hmm.
And
Hmm.
actually, I think that's not true. So the
Okay.
running cost
Hmm.
of PPLIs is generally maybe a setup cost of 1% or less,
Hmm.
and an
Hmm.
ongoing of 1% or less, right? And
Hmm.
oftentimes when we do these structures, we do a cost benefit analysis on these different
Hmm.
things. And
Hmm.
let's say if you're a US tax resident, for example, right? If a
Hmm.
US tax resident you may have a tax drag on a short-term basis of 37%. If you're a California tax resident, there's another 13% on top of it, to close to 50%, plus maybe 2% Medicare, so well over 50%, unfortunately. Or even for a capital gains basis, it's 22% plus the 13, right? But even if you're living offshore, it's 37%, 20 or 22%, depending on how long you own those assets. In a PPLI structure, one of the key things that it allows you to tax defer any of the gains you make. So basically, if you have any capital gains, you don't have to pay those taxes right away. It just accrues and capitalizes. So basically, you don't have to pay those taxes. So, paying 22% tax versus paying 1% on overall assets, a lot of times the math makes sense, right? You're actually net ahead by doing these different things. There's also some interesting things we can do around with reclaiming withholding taxes. So, let's say, I'm based in Singapore, for example. I have a lot of clients in Singapore. They may invest in a lot of US stocks. Everybody invests in US stocks. Everybody buys Apple stock or Amazon or Exxon or Walmart. A lot of these stocks may pay dividends. Unfortunately, there's a withholding tax, which you may or may not be aware of. And the withholding tax coming out of the US is traditionally 30%. That's the standard withholding tax. Singapore, if you're a Singapore tax resident, you pay 30% withholding tax. But there's a neat quirk here is that we have insurance companies in 15 jurisdictions. And all of a sudden, I can pick a jurisdiction that has a very good double tax treaty. Let's say it's in Ireland or Luxembourg. So it has a very good double tax treaty, or in Austria, very good double tax treaty, because these countries have been friends with the US for a long time. And all of a sudden, the withholding tax is not 30%, it's 15%. And that's just free money, right? So I have one client, for example, last year in Singapore, we saved in $60,000 in just reclaiming withholding taxes from the US or from the UK or from Switzerland, lots of different things. So there's lots of unique sort of things that we can do with these different structures that actually makes it very cost effective. And oftentimes, the marginal cost is you're many times ahead by using these structures than not using them.
Okay, sticking with the cost element. I know you said 1% setup, 1% ongoing,
or less,
but or less. But from your point of view, is there like a threshold below which, even though it's 1%, it may not be worth your time, or you're gonna
we're quite open, right?
Anybody can come. Yeah, anybody can come.
Yeah. So look, I mean, I think usually we start at 5 million for these types of structures. And a lot of times I even have cases where I've done it 2 million. Right? Everybody. So I think it's a very accessible type of a structure. Lots of different nuances to it, but we've been doing it for a long time, right? And that being said, we have these structures can go as I have some clients as big as 500 million, right? And everything in between. So it's not just for the very, very big or for the very, very small. It's sort of for everybody. And it's a very flexible structure, and it's very easy to use. I think a lot of times people will compare these things to, let's say, a trust or a foundation or an offshore company, right?
Correct.
The thing is, each thing does a different thing, right? So it's an apples and oranges comparison, to be honest with you. In my mind, a trust is very good for succession planning, right? When my kids are 18, they get this. My grandkids come up, they get that. But if you want, a tax blocker, if you want, some of these privacy or asset protection things, a lot of times the trust is no longer there, right? Because of CRS or FACTA and CFC rules, it sees right through these different things, right? And for example, a US trust has its own tax ID. It pays capital gains tax. It pays income tax on any trades you make. So you can layer a trust with a PPLI, right? The trust will take it, help with the succession planning, but also help you with the estate tax issue. And the PPLI will help you with the capital gains tax issue. So it's different. You layer the different things. Each one does its own heavy lifting for different things. And so there's lots of cases where you may want these structures in combination. And then below that, you actually may even want a Singapore company or an offshore company, a PIC, for example, a private investment corporation, or a California LLC or Delaware LLC, just a holdco of some sort, which then holds your underlying assets. And that way, it's easier to move your assets around, right? Not holding the underlying assets. So with these, in this day and age, it's not an either or anymore. It's an and structure because it's so complicated these days.
Yeah. Understood, understood. But it's generally, taking a step back, it's a structural tool from one generation down. Because once there is, I guess, a trigger, I guess the
Yep,
passing
correct.
of the person who's
Insured
setting up,
person. Yep,
it's no longer in existence, right? Or does it
correct.
continue?
So
Mhm,
yeah, so exactly. So there is a
mhm,
trigger event with these types of
mhm,
structures, right?
mhm,
So it's not indefinite, right? Or not 100 years. A lot of trusts either 100 years or they're indefinite, depending on jurisdictions. With this,
mhm,
there is a trigger event. There's a life
mhm,
insured, right? So it's
mhm,
based on someone's life. Once that person's passed away, there's a
mhm,
trigger event and there's a distribution to the beneficiaries, right?
mhm,
But the beneficiary can actually be a natural person, your
mhm.
children. It can be actually a trust, and that's
Or
what we actually
foundation,
recommend.
yeah.
You can be going to a trust of some sort. It can be even
Mhm,
to a family holdco. So some families have
mhm,
a family office that's set up that's in a
mhm,
family holdco. You can distribute to that. But a lot of times we
mhm,
say, look, have it distribute into a trust or a standby trust. The
mhm,
standby trust actually has those letters of the instructions that you want beyond the
mhm,
grave, right? So the
mhm,
distribution
mhm,
of assets. And then once it gets distributed,
mhm,
day one, day two, you do another PPLI on the life of the second
mhm,
generation. And then it keep on
mhm,
repeating, right? So there's lots of
mhm,
different sort of variations that we can do. And then
mhm,
sometimes we can not even, do the trigger event, not off the first generation, but off the children right away.
mhm,
There's certain cases where you want that to happen, right? Or you
mhm,
can do joint life, second last to die, right? So I can
mhm,
do myself and my wife and whoever last to die, and then the trigger event happens, right? Or
mhm,
myself and one of my oldest son, and then the trigger event happens. Lots of different combinations for different use
mhm,
cases. This
mhm.
gets quite esoteric and customized, and that's why we're here to sort of help you walk you through that process.
Okay, thank you for that. And generally speaking, I know I would imagine that it can get quite technical, but what would be the basic, like high level differences when you set it up for a US family as opposed to a non-US family, just generally
Yep.
speaking?
Yeah, so just so you know, PPLI actually originated from the U.S. It's
Okay.
in a U.S. structure, right? And
Hmm.
it was invented, I think, in the late 70s. So it's been around for
Hmm.
quite some time. It's sort of withstood the test of time. It's been around for over 40 years, right?
Hmm.
Over time, there's been lots of iterations on it, right?
Hmm.
Um, Fair enough.
Hmm.
But in general, with the U.S. structures, obviously it's the most strict because the U.S. tax code is the most strict. But there's
Hmm.
two key rules we sort of have to pay attention to the U.S. Number one is it has to be cannot be self-directed. It has to be
Hmm.
arm's length. I cannot manage the assets myself. I need a
Hmm.
licensed manager to manage it on my behalf. Okay.
Hmm.
Whereas in other jurisdictions, that's optional. It's ideal, but it's not necessary. That's
Hmm.
number one. Number two is that it has to be a diversified investment pool. It has to be at least five different investments.
Hmm.
One investment cannot be more than 55% of the overall portfolio. Two can't be more than 70%. There's some really
Hmm.
strict rules we have to follow. So
Hmm.
it just can't be like one asset that's worth 90% of the overall pool, right?
Hmm.
And then one share of four different
Hmm.
stocks. It can't be like that. It has to be a diversified
Hmm.
investment pool. There's certain rules we have to pay attention to. Those are the two key rules for the US that we have to pay attention to. There's some other smaller ones, but in general, those two key rules, if we can pay attention to those key rules, we're
Hmm.
95% there.
Okay, gotcha. And I guess the one that really stands out is the, let's say, the hands-off rule.
Yep.
So I would imagine that that could be a challenge for some families who have got accustomed to being in control.
Yep.
Could you talk a bit about the hands-off rule and how you manage it
Yeah,
and how you
so
guide families through
that's
it?
a very good question. So as I said, it cannot be self-directed.
Hmm.
So you cannot be the one punching in the trades.
Hmm.
You cannot be the one, deciding what to do, right?
Hmm.
You have to give a discretionary portfolio to your asset manager.
Hmm.
It can be any asset manager. It can be to your private bank. It can be to Goldman or
Hmm.
Pictet or Julius Baer or Morgan Stanley or Citibank. We work with all of them. They have
Hmm.
discretionary portfolios.
Hmm.
Oftentimes you can actually, set out in principle
Hmm.
what the direction is. I want to be more aggressive. I want to be less aggressive.
Hmm.
Whatever that overall the overall portfolio is going to be, right? That
Hmm.
direction of it. But the actual stock picking, the actual decision to buy and sell that particular stock or that security or that bond has to be
Hmm.
in the hands of that investment manager, right? If you
Hmm.
cannot do that, then this may not be the right structure for you. Okay, it's really important to
Yeah.
have that arm's length. Um, that arm's length sort of decision-making process, right? It cannot be self-directed. And that's a very bold line we emphasize all the time. It cannot be self-directed, right? And that's very, very important. If you want to be self-directed, fantastic. This may not be the right structure. You just keep it outside the structure and pay your 50% tax or 37% tax, depending on where you are, right? But if you want that tax deferral, right, not buying, selling assets without paying those taxes right away and just accruing them forever, you have to follow these rules.
Okay, understood. Now, when we started off talking, you mentioned that it was very much a boring structure. It flies under the radar. It's been tried and tested. Are
Yep.
there any jurisdictions, major jurisdictions, that have kind of caught on to it and are giving it special attention, or does it still continue to fly under the radar?
It just tends to fly under the radar because it's in life insurance, right? If I'm a politician and I'm saying, let's go after trusts, let's go after our offshore companies. Everyone says, yeah, fantastic, let's get out pitchforks. Those are things for the rich, right? But if I say, I'm going after life insurance, everyone starts to be very concerned, right? So because of that, life insurance at its very core is for widows and orphans. Widows and orphans need to be protected, right? At its very core, it's for widows and orphans. And so all these different benefits come from that, right? And then because of that, it's very difficult for you to discriminate between, the average person or the less wealthy person and the very wealthy person. You can't do you can't really discriminate between these different things, right? And so I think that's the reason why, it's been around for 40 years. It's withstood the test of time. It's gotten more strict on how we use it. These investment diversification rules, these, can't be self-directed. We can't abuse these structures. But, with any sort of structure that's out there, if you use it correctly, you're going to be fine. If you abuse the structure, you can get in trouble. So don't abuse the structure.
Okay, gotcha. So I think we've pretty much covered everything. Are there any final words that you want to share? Any final comments?
Yeah, so I think these structures tend to be very good, right? Whether let's say, if you're a U.S. person living in the U.S., we have structures for that, right? And you can defer your taxes. So as I mentioned, for the U.S., for Western Europe, for UK, for Australian clients, it's all about tax optimization. And the key way that happens is through tax deferral. Basically, if I buy an asset for $50 and I sell for $100, usually maybe $50 of gains. Under life insurance, the life insurance company does not have to pay those taxes. Whereas you and I have to pay maybe $25 of taxes. $75 comes back to me. In life insurance, the full $100 comes back. There's no tax drag as long as it stays within the structure. So I can move between assets. I can go between securities to bonds to crypto to real estate to operating companies to private equity investments and all the way back, all within the structure without having that tax drag. So it's very, very powerful in that way. The other thing is that, if you have families who have, let's say, kids or beneficiaries in different jurisdictions, or you're planning to move to different jurisdictions, these things are a very, very good structure. So, for example, we have a lot of clients who are going to be moving to the US or to Spain or to Portugal or to Australia. And you can do a lot of structuring before you move to make it tax efficient before you go there so that it doesn't get caught in the tax traps. So a lot of clients, for example, I'm seeing in Singapore, it's a very low tax jurisdiction, right? So I think the personal income tax, I think, is between 17 and 19% versus, let's say, Australia, which is over 50, right? Or if in California, again, over 50. You can structure it before you migrate or immigrate to Australia or US, UK, and then it doesn't get caught up in the tax nets there. So it's a very, very powerful type of thing. And oftentimes, even in some certain jurisdictions, let's say Spain. So Spain has the non-habitual rule, the 10-year non-habitual rule, right? Which basically says that, I think all your income taxes, you don't pay income tax for 10 years. But the one asterisk in there is that you do have to pay capital gains tax. And a lot of wealthy people actually make money on capital gains, not on income, because wealthy people tend to make more money on assets they own. They don't have to work, right? So, so any capital gains will get caught up in it. But if you structure it properly before you migrate to Spain, then you may not have to pay those taxes, or you may be able to defer those taxes forever, right? Which is very, very powerful, right? As long as you structure it correctly and you get a Spanish compliant policy and follow the rules for each of the different countries. So I think, the key thing is that these things are very, very flexible. It's important to have a very good advisor who's used to cross-jurisdictional issues, right? A US policy and a UK policy and a Spanish policy and a French policy and a Belgian policy and a Chinese policy may be all very different. Find somebody who has that broad sort of expertise to be able to navigate across jurisdictions, if that's your case in your family, and most families now are like that. And seek sort of professional advisors like Darren or myself. And that's probably the best last words.
Okay, fantastic. So asset protection, succession planning, estate planning,
Yeah.
pre-migration planning.
Yeah.
It could be a silver bullet for the right family.
Right. We like to think so. And the easy way to sort of remember the different benefits is Patek like the watch. I don't have one. It's P for privacy, A for asset protection, T for tax optimization, E for estate planning, and C for a cash component. If you have one of these needs in your family, reach out to Darren or myself, and we'd be happy to sort of walk you along and walk you through the process.
Fantastic. Thank you very much. And again, if someone wanted to reach you, what's the best way to get to you?
Yep. So I think probably to reach out to Darren, and then Darren can contact myself. Or my email is simply my last name CHI, as you can see on the screen, at 1291group.com. So it's just my last name. Yeah, CHI at 1291group.com. I think the easiest is reach out to Darren. Darren knows where to find me, and Darren's team knows where to find me, and we can take it from there.
Fantastic. Roger, thank you. It's been an honor.
Yeah, thanks very much for your time.
Okay.
All right, take care, everyone. Bye-bye.
All right, bye-bye. And we're off.